Welcoming you to this week's edition of the Tax Talk with AJ. This weekly show brings you all the updates that you really need to know when it comes to taxes, whether personal taxes, business taxes, corporate taxes. And the show is brought to you by Sai CPA Services, a full-fledged professional accounting CPA firm located in the state of New Jersey. Multiple locations, but they can help you, assist you with any tax-related matter, no matter where you are in the United States of America. They can be reached at 908-888-8900 or visit their website, scicpservices.com. With that note, I'd like to welcome Mr. Ajay Kumar, CPA, CVA, and MBA with Sai CPA Services with over 25 years of experience. He joins us every week and he guides us, enlightens us with the tax-related matters. So, Ajay, thank you. Welcome to the show.
Thank you, Sanjeevji. Thank you for the kind introduction.
You're most welcome, Ajay Kumar. And of course, you and Science CPA Services, entire staff is Science CPA Services, knowledgeable CPAs, experienced, and ready to assist with any tax matter. Been helping hundreds of thousands of clients nationwide, and that's why you have the highest reputation in the world of CPA. So we appreciate your time joining us every week right here on ITV Gold to talk about taxes. Now, when it comes to taxes, obviously, everyone pays, but most of the people don't want to pay. Why pay taxes? It's a very, very popular thing. Why pay taxes? Government doesn't need money. And there are people who would say, listen, whatever taxes I need to pay, I will go ahead and pay. I'm coming to the point to ask you a question, AJ, is that one is that can tax liability be reduced? Tax bill, tax liability, whatever you call that. Are there ways that if any one of them, those strategies apply, or maybe a couple of strategies apply to individuals' tax return or corporate tax return, can they save money on taxes?
Absolutely, Sanjeevji. Undoubtedly. We had another episode, and if you missed it, please check on the YouTube. We have a Sai CPA Services YouTube channel. You will see in one of the earlier episodes we covered billionaires, top 400 billionaires pays lesser taxes than general individuals. Most taxes are paid by people who are filing their own taxes, who don't have the right professional help. So tax is not a book. Tax is not a form. Tax is a library. There are a lot of strategies. Well, of course, not every strategy is going to be applicable to everybody. But there are a lot of strategies that you can use in your situation to see how do you reduce the tax bill, how do you reduce the tax liability in your situation. We'll discuss few,
Yes,
Sanjeevji. And again, not everything is going to be applicable to everyone, but look at your situation. Seek professional help if you don't understand something. Do a lot of research, but there are definitely smart tax strategies that we'll be covering today, a lot of ways that you can use to reduce your tax liability.
Well, you mentioned a good point that not all the tax strategies will be able to apply to one person, but even one strategy to one person and the other strategy to another person, if it
Absolutely.
works, then obviously you can reduce your tax bill. And that's why Ajay Kumar or Science CPA Services calls this smart strategies to reduce your tax liability. So number one is the retirement contribution. Let's give some more information on retirement
Absolutely.
contribution.
So the idea is your tax liability depends your taxable income. How do you make a lot of money but reduce the taxable income? And the difference, or part of the difference, comes from investing into your own retirement account. If you invest into qualified plans, for example, 401k, if you have a job, you qualify for 401k. If you have a small business, you may qualify for SEP, Simplified Employee Pension Plan. Everybody, if you have earned income, you qualify for IRA, Individual Retirement Account. If you work for non-for-profit company, you qualify for 403B. Again, depending on your situation, you choose what plan you qualify for, how much money you can put in there, and the amount of money that you are putting in your own retirement account is tax deductible. You don't have to pay tax on that money right now. By the time you retire, you will be in a much lower income tax bracket. the tax liability will be lower at that time. So you can reduce the taxable income by choosing a proper retirement plan in your situation.
Okay, and then for that, I just want to let you know, viewers, one thing is that all these strategies, obviously, that's good to know. You should really know. And if you think one of them can apply to you, but if you're not sure about that, I would suggest do contact Science CPA Services, make an appointment. Because remember, one thing is many people don't understand, but this is a fact. We're in month of October. So October, November, December, this is the last quarter of the year. Whatever tax liability that you want to reduce, this is the time that you can park money in the different plans. Once you park your money over there, then obviously your tax liability would go down. And that's why you need to consult Science CPA Services, and their knowledgeable, experienced staff will help you out. 908-888-8900. And retirement savings is one area where there are several options which definitely could apply to one of you. All right, so give it a try. Second, AJ, is they say HSA, Health Savings Account.
So health saving account is an account where you contribute through your employer, and then this money can be used to pay for all the co-pays, all the health related payments, doctor's bill, hospital's bill, medicines, all those things can be paid through this HSA plan. It's a pre-tax plan, so it reduces your taxable income. For an individual, the limit for 2025 is $4,300. For a family, is $8,550. So make sure if your employer, again, not everybody can use this plan. Your employer, where you work, must offer this plan. Not many employers offer this plan, but if your employer offers this plan, HSA is called, or FSA, flexible spending account, make sure you make use of it.
Okay, that's a very good point. Moving on to the next one, there are several tax credits. One popular is child tax credit, but obviously there are several of it under that name. Can you elaborate?
Absolutely. So there are a lot of tax credits. I want you to understand a tax credit lowers your tax liability dollar for dollar. It's not tax deduction. Deductions lower your taxable income. So tax credits are much more useful, much more beneficial than the tax deduction. So when it comes to tax credits, there are a lot of them. There are child tax credit, then there are earned income credit, then there are American opportunity tax credit, then there is savers credit, and every credit has a different limit. Let's say, for example, child tax credit. It used to be $2,000. Now, from 2025, is $2,200. Best part, out of $2,200, $1,700 is refundable. Savers credit is $2,000. Earned income tax credit, more than $8,000 if you qualify. There are a lot of these credits. American opportunity tax credit, $2,500. There are a lot of these credits that you can qualify for. Make sure you know in your situation what credits applies to you. And do some research. Seek professional help if you don't understand. But tax credit is a blessing. It lowers your tax liability, and a lot of these tax credits are refundable, meaning if you have zero tax liability, you get the money back from the government.
Okay, there are several points in the tax credit, so do look into it, viewers. AJ, filing status, does that really help? Filing status, doing it rightly, can reduce your tax liability?
Absolutely, 100%, Sanjeevji. The biggest mistake people make, and I'm saying one of the biggest mistake here, if one spouse happen to pass away, people tend to make mistake of married filing separate or single for 2 years after the death of the spouse. Excluding that year, you still have the right to file a qualified widower, which gives you similar benefit as married filing joint. In the year of death, you can file married filing joint. For next 2 years, you can do qualified widower, which can save you a lot of money. If you qualify for married filing joint, make sure you do married filing joint. In most cases, there are special circumstances, but in most cases, married filing joint will result into lower tax liability than a single filer. Look at married filing separate versus single versus married filing joint versus qualifying widower versus head of household. If you have a dependent, even if you are single or divorced, You probably qualify for head of household. Make sure you understand the rules. Make sure you understand your situation and use the best filing status in your situation.
This is the first time I'm hearing that, when a spouse passes away, the other
A
person
lot of people don't know
can
about it.
use 2 years as a
A
qualified
lot of people
widower.
don't know about it. And it's unfortunate that people leave money. The worst part, Sanjeev ji, if you take more money from the government, you will get a notice from the government that this is what you did wrong and we want this money back. If you leave money on the table, if you qualified for qualified a widower or married filing joint, and you did not do it, you did single, and hence you gave more money to the government,
That's not
you
going to come
don't get
back.
a notice.
That's not going to come back.
You don't get it back. This is your choice.
Because government IRS thinks that whatever status you put in, assumed you did it right. So then, whatever the overpayment is, they're going to keep it. Anyway, folks, with that note, we're going to take a break. And remember, today's topic is how to reduce tax liability. When we come back, we're going to have a lot more information for you right here in the Tax Talk with AJ. Stay with us. Welcome back to the second half of the Tax Talk with AJ. All right, so moving on to the show, folks, this week's topic is how to reduce your tax liability. As we covered, a couple of strategies, now we're going to go and look into 529 plans. What exactly is 529 plans and how does it work?
So 529 plan is an education plan which was originally started to funds children's education, and it was not used as effectively earlier, especially prior to 2017. In 2017 Tax Cut and Jobs Act, it was increased to 10,000. Now with OBBA 1, it has been increased to 20,000, and not just the amount has been increased to 20,000, the way you can use this plan, even private tuition, home tutoring, any education, it doesn't have to be your field. I'm an accountant and I want to learn basketball. So be it. Anything you can use for the education purpose, for your own education, for your own children's education. And the best part, the growth on 529 plan is not taxable if you do it right. So make sure you have a 529 plan for your children.
Okay, very good. If you do it right during the year and if you keep track of it and if your number is correct, this can definitely help you on your tax return to reduce your tax liability. And I know about this, and that's why I'm telling you that if you really keep track of it entire year and you know exactly whom you gave, how much you give, and that is charitable contributions.
Absolutely. So if you remember, charitable contribution is a function of itemized deduction. If you're itemizing on your tax return, only then you get to use the charitable contribution. But starting next year, not this year, starting next year, $1,000 per person for a married filing joint type of situation, $2,000 can be claimed as charitable contribution without itemizing. But make sure, as Sanjeev ji said, keep track of your receipts. The receipts have to be contemporaneous in nature. You have to have the receipt at the time of filing the taxes. You can't say, if the need be, I can get the receipt. That doesn't work. You have to track, I put the money in hundi. Doesn't work. I gave money to the Panditji. Does not work. It has to go to a charitable organization that's registered with IRS. Giving money to the foreign organization, I send money to India in a Goshala, does not count. So it has to go to a 501c3 registered with IRS. But if you keep track of it, it can save you a lot of money.
Okay, and the point is, try to get receipt for every single contribution that you made, and if it's a 501c3, they should not have any problem to give you receipt, because remember, they're also saving money on their taxes. All right, so your contribution is important to them, and while they are saving money on their taxes or not paying taxes, whatever their status would be because of 501c3, they should be able to give you a receipt. So make sure that you get that. Now, let's talk about business deductions. For especially, we talked about personal tax returns and for personal tax filers. Let's go into the business side to see what business deductions are there entitled.
Absolutely. So leveraging business deduction is extremely beneficial if you have a small business. Again, it only applies to you if you have a small business. But anything that you're doing for this business, including travel, phone, internet, taking the potential client out for lunch, meals and entertainment, creating a website, getting the business card, going to the networking meetings, going anywhere to develop the business. If you have an IT consulting company, going to India could be a business expense. You're trying to open a business over there, trying to open a company over there. So in your situation, you have to see what business expenses I can claim. And the rule of thumb is you ask yourself, would I have had this expense if I did not have the business? If your answer is yes, then it's not a business expense. Say, for example, your meal, you would have eaten anyway. Business or no business, you need to eat. So your meal is not deductible. But probably you will not be taking the potential client out if you did not have a business. So client's portion of the meal expense, meaning 50%, you ate with the client 50%, is tax deductible.
Absolutely, that really helps. All right, moving on to the next one. As earlier we discussed, and AJ really clarified that filing status, as much as filing status is important for individual tax filer, let's talk about business side. On a business side, you have a business, and there are several ways to have your entity: S corporation, C corporation, LLC, and whatnot. AJ, what is the best corporation that you can suggest for what industries, so that way they can save the taxes?
Absolutely. I'm glad you clarified what's the best structure for what industry. Typically, we are asked, what's the best type of structure? And I say there are 5: proprietorship, partnership, LLC, S Corp, C Corp. They are all good structures for somebody depending on one situation. Say, for example, most professional company, doctor's office, attorney's office, accountant office, architect office, they are generally S corporation. Most real estate businesses, when you have an investment property, they are typically an LLC. Most foreign-owned company, when you have somebody from India owning certain part of the company, or somebody from Dubai owning certain part of the company, most of those structures are C corporation. If you just have a side hustle, most of those companies are proprietorship. So you have to see in your situation what type of structure makes most sense. And each structure has different taxability. Say, for example, LLC pays 15% extra taxes. We call it self-employment tax than an S corporation. So if you have a profitable business, you may not want it as an LLC. Then you want it as an S corporation. If you have a real estate company where the depreciation, property tax, mortgage interest will always be higher than the rental income, meaning the business on paper will always show losses, then LLC is a good idea. So please understand the different type of structure and see what makes most sense for you.
That is absolutely very, very important, because having a right entity, and also with your tax brackets and everything else, and what kind of business comes into place, it's also important. So when you think about starting a business, and before you finalize an entity, give Science CPA Services a call, get their advice and suggestions. Just a one meeting, and then golden advice is definitely worth it in the long term for your business. All right, moving on to the next thing is the tax harvesting investments. How does that work, and how can you save money when you harvest your investments?
Absolutely. So, and this is the appropriate time for this strategy. We call it tax loss harvesting. So, a lot of people have a lot of large capital gains. Right now, in October, November, December, please look at your investment portfolio, see what capital gains you have. Then you look at the stocks, the shares where you are losing money, where you're underwater. Identify certain shares that can be sold. You can buy them back after 30 days. So there is a wash sale rule you have to be careful about. You cannot buy and sell the property 30 days prior or 30 days after. But the idea is, knowing that you are sitting on capital gains, if you can identify certain securities where you are losing money, you can sell the losing money securities to offset the capital gain with the tax loss. So a little bit of planning can result into a lot of saving if you play it right using this tax loss harvesting formula.
Okay, very good. Just a couple of questions from layman's side, from regular viewer side, to see what they can get out of this. What about medical expenses? Are they deductible? And if they are, how much? Is there a limit?
Well, medical expenses in theory are deductible. First, you have to itemize. Second, medical expenses in excess of 7.5% of your AGI are counted. So if you are making, let's say, $100,000 and your medical expenses are $10,000, only $2,500 counts towards your itemized deduction, and then you have to bypass the standard deduction, like $30,000. So it becomes difficult to claim medical expenses. That's why we have HSA, health spending account, where for individual you can have $4,300 in that account. For a family you can have $8,550 in that account. So if you have that much money, up to that much money, you can fund it pre-tax. So you can spend the money from that account and still get the tax advantage.
Okay, very interesting. All right, just a couple of other questions also for individual taxpayers. If someone sells their home, and obviously there's going to be, let's say, capital gain looking at today's market, right? What would happen to them? How would they justify that on a tax return?
I'm glad you asked. And a lot of people make this mistake. If it's your primary home, if you have been living in that home, you don't have to pay capital gain tax. How much capital gain tax you pay? Zero. What's the rule here? The rule is if you have been living in that house for at least 2 years in the last 5 years from the date of sale, you are exempt from the capital gain taxes up to $500,000 for a married filing joint person. For a single person, $250,000. Imagine a situation, you bought a home for $200,000, you are selling it for $700,000, and you pay zero capital gain taxes because you have been living in that house for 2 years. It gets interesting. You were living in that house earlier, but now it's rented. Try selling it in the first 3 years. So the rule is 2 years out of 5 years from the date of sale. So if you sell the house in the 3 years, even if it was rented, you don't pay the capital gain taxes. So make sure you understand the rule. This is why we call it a smart tax strategy. It's not a book, it's a library. Knowing is the key. Make sure you understand what's applicable in your situation.
That's interesting that, so if somebody lived in a house, let's say 30 years, they paid their mortgage off and everything, they decide to sell the house. They live 30 years in the house and their capital gain is close to $500,000. They don't have to pay any taxes.
Zero. First
Even if they go out and buy another house with that money.
They don't have to buy another house.
That's a
if
great
they
benefit.
want to buy another house, they can consider 1031 exchange, but typically that's done for investment property. For primary home, there is no capital gain up to $500,000 for a married filing joint tax situation.
That is amazing. I don't think many people know about this, and thank you for pointing that out. So these are some of the things, and obviously every week there are many things that AJ comes and shares with us, where you can reduce your taxes, and also about taxes laws and changes in the taxes laws. And that's why this is one of the most watched shows. Viewers, thank you so very much for watching this show, The Tax Talk with AJ, every week right here on ITV Gold. The show is brought to you by Science CPA Services. Give them a call right now, 908-888-8900, or visit sciencecpaservices.com. Remember to have your taxes done right, and at the same time get knowledge and education about taxes from Science CPA Services, Mr. AJ, and one of his experienced, knowledgeable CPAs. AJ, thank you so very much for your time.
Of course, Ajay.
All right, I am Sanjeev. Until we meet again, same place, same time, do take care of yourself and have a tax-free days ahead. So long.
Thank you.